Is the Federal Reserve still on the right track in terms of monetary policy? Are valuations for the markets overstretched right now, or are they fairly valued? We're here to discuss these topics with Lyn Alden, founder of Lyn Alden Investment Strategy. Lyn, welcome back.
Hey, thanks for having me back. Glad to be here.
When it comes to macro research, you are second to none, so we will focus our conversation on macro for today, starting with one of my favorite topics with you is monetary policy. As you know, the Federal Reserve met this week to discuss what's next. They have kept rates near zero. That came to a surprise to no one I've talked to. Now, my question to you, Lyn, is when could they expect, or when would you expect them to raise rates?
So far what we're seeing is that they're sticking to their plan. And so regardless of whether or not someone likes their plan, that's what they're sticking to. And so far that their plan is basically that they changed their inflation policy somewhat in the sense that they want to have average inflation targeting. So rather than treating their 2% more like an upper, kind of like a ceiling where they start to kind of get concerned, they're basically pointing to the fact that according to the way they measure inflation, they undershot it, the past 5 years or so. And so now they want to mildly overshoot it so that they look back and have, roughly average 2%. And so basically their policy is to not front run inflation expectations. So if they see inflation coming, they don't plan on kind of preemptively hiking rates to deal with that. And so they've described it as they want to see inflation kind of over 2% for a considerable amount of time. And so basically they're aware that we have upcoming base effects. So already March, inflation was over 2% year over year. CPI at least was more than 2% year over year compared to last year, and the April, May, and June numbers are going to be higher because you're comparing to a very low inflationary period of last year, which was the heart of the shutdowns. And so with all the fiscal stimulus in the economy, with reopenings, and with those base effects, we're going to get pretty high numbers. And the Fed is, they're kind of trying to control the narrative by pointing out that, in their view, they'll be transitory and that they don't plan to, do emergency hikes right away. But I think, with the inflation coming down the pike, I think they're starting to gently, tell people that, the tapering is potentially on the horizon, rate hikes are potentially on the horizon, but they're not getting to them very quickly until they actually see persistent inflation the way they measure it above 2% for, a period of time.
Could that happen anytime this year?
Well, so it depends. They've been kind of vague about what they mean by a period of time. And so we have to assume that both magnitude and duration matter. And so some of the magnitudes that people are forecasting with models are rather high for this late spring and early summer period when you have the combination of those base effects and all that fiscal response. And so if they blink, it's possible they could pull forward some of their tightening due to magnitude more so than duration. On the other hand, if they hold firm and kind of look through those few months, inflation could then go back down. At least again, the way they measure it could go back down to that 2 to 3% range, and they might be willing to hold that for a period of time. And so basically, there's an order of things they could taper. So before they hike rates, they probably would start dialing back their asset purchases. They're still purchasing treasuries and mortgage-backed securities at a rate of about $120 billion per month. And so they could start dialing that back, to 80 billion to 40 billion, before they look at hiking rates. And the longer term problem with hiking rates is that there's so much debt in the system that every time they hike rates, they basically start running into a credit issue. And so I think even when they get to the point where they have to hike rates, that's going to cause issues, and it might have them reverse course probably faster than they think. I don't think they're going to get to a period of normalization anytime soon.
Let's take a look at the other side of the coin now. The other mandate that the Fed has is full employment. As you know, the unemployment rate has come down steadily since last year. It's currently at around 6%, the non-farm unemployment rate. Now, one metric that the economists look at is the non-accelerating inflation rate of unemployment, otherwise known as NAIRU. Now, NAIRU measures the unemployment rate at which inflation stays constant. So do you think that this is a measure that the Fed cares about? And do you think that if the unemployment rate needs to come down even further before inflation stabilizes?
Well, so what they're basically doing is they're focusing on multiple metrics, including broader metrics of unemployment. So Powell's actually cited some of these broader measures, and so they're taking a pretty conservative view about that. And so basically, between their two mandates of price stability and employment, they're full on in the camp right now of trying to emphasize employment. And so that's why they're willing to let inflation run hot in their view if it means letting employment kind of rebound. So even though the official unemployment rate has come down somewhat, if you look at say the number of jobs in the economy, we're still very very short of what the total number of jobs were pre-pandemic. If you look at the labor participation rate, the employment to population ratio, and broader measures of people that are marginally attached to the workforce or underemployed. So if you look at those broader metrics, we still have a long way to go to get back to the jobs that we had, prior to the pandemic. And that, jobs are generally a lagging indicator that they're some of the slower things to rebound. Whereas, retail sales can bounce back quickly, GDP can bounce back a little bit after that, but jobs are kind of a longer term thing. And so that's why they're trying to be more accommodative to basically, they're trying to have that pro-inflationary, pro-job growth environment, and they're willing to kind of make that sacrifice on the inflation side. And so that can, obviously be an issue for people that are invested in cash or invested in bonds.
We know jobs are a lagging indicator. Let's talk about something that isn't lagging, Lyn, which is prices of markets, valuation levels. Now, you've written an article recently, fascinating read. I encourage everyone to check it out on lynalden.com. It's about market capitalization, and you've listed a few examples of various asset classes and how, according to you, their value. First of all, why don't you help us define market cap in your words, and how this relates to current valuations right now?
Sure. So the market capitalization of a company is the number of shares multiplied by the price of those shares. And so basically it's the theoretical value of the whole company. And then if you extend that and you say, what is the value of all publicly traded companies? Then you basically get an idea of what is the full value of the market. And then you can compare that to other large economic indicators like GDP and say, okay, what do asset prices look like compared to the size of the economy? How much economic output we have in a year? How does that compare to asset prices? And of course, that's one of several valuation metrics. You can also do the cyclically adjusted price to earnings ratio. You can do price to sales ratio. There's a variety of different metrics you can do, and it's often good to use multiple metrics because they help kind of fact check each other. And so one thing we've seen is that in over the past year, we have a record high market capitalization to GDP ratio in the United States. And so that's not the case in many other countries. But in the United States, we've had, we've reached very high valuations, even higher by that metric than the dot-com bubble. And so that's interesting because most metrics show that we're probably the second most, expensive ever. If you look at the cyclically adjusted price to earnings ratio, if you look at, dividend yields, things like that, we're roughly second to where we were in the dot-com bubble, but by a couple metrics like price to sales ratios and, market capitalization to GDP, the United States has never been more expensive than it is right now.
In your article, you talked about Bitcoin, gold, and equities. Before we talk about how market cap applies to gold, I like to just first ask you, generally speaking, which of these assets that you've discussed in your article do you think is the most overvalued?
So by most metrics, I mean equities are more overvalued than other asset classes. Gold historically is there's different metrics that show by the most conservative metrics it's undervalued. By more aggressive metrics, it's maybe fairly valued. And so, for example, if you look at gold compared to other commodities, still you're generally on the more pricey side for gold. If you look at gold, how many ounces of gold it takes to buy the median house, you're still looking a little bit more on the pricey side for gold. But if you're comparing gold to the amount of broad money supply in the system, if you do it on a per capita basis, or if you take into account gold's inflation rate, basically the mining rate, that's about fairly valued. If you look at, for example, how much gold the U.S. Treasury has compared to the money supply, that's very cheap by most metrics. Basically they have a smaller percentage of broad money supply backed by gold, indirectly, than most times in history. So there's a range of different metrics, but overall, gold's not too frothy at the moment, especially after the 8-month correction that it's gone through. Bitcoin's always a challenging one because it's a smaller asset. It's in the process of being adopted. There's different ranges for estimates for how what is its basically what is its total addressable market size. So could it reach half the size of gold? Could it surpass gold? Basically, depending on who you talk to, it could be
Mm-hmm.
anywhere from zero to multiple times the size of
Mm-hmm.
gold. But basically, again, we've been in a large correction, more like a consolidation for 2 months now, where Bitcoin's been choppy and sideways, and so that's taken some of the heat off. And so Whereas if you look at the stock market, that's where, but even there, it's challenging because the big curveball is that if you look at the dot-com bubble, you had treasury yields of like 6%. And so the fact that stocks were so highly valued compared to bonds made stocks clearly a worse choice than bonds in that environment. And that ended up being,
Mhm.
forward true. It was much better to have bonds. The problem now is that bond yields are so low that actually based on the equity risk premium, stocks still aren't overvalued. And so basically the way to interpret that metric is that stocks are expensive, but then in many metrics, bonds are even more expensive. And so that's the challenge that investors find themselves in, is that the three largest asset classes are the bonds and cash, equities, and real estate. And so they're basically bouncing back between all these different areas that are overvalued.
Now, I'm curious to learn more about what you just said in regards to gold market capitalization. Uh, your definition for the equities it makes sense. I mean, that's a pretty standard definition for the market cap of a stock or a broad index. How do you apply that to gold?
So gold's trickier because it's obviously we don't know the exact amount of gold that exists in the world. But that for example, the World Gold Council has public estimates for how much gold has been mined and is still available. Because virtually all gold that is mined stays in circulation because that's one of the traits of gold is that it's infinitely reusable. Small amounts of get thrown out in electronics and things like that, but the majority of it's still around. And so if you go by their estimate based on, and then multiply that by the price of gold per ounce, that's where you get, a range of maybe 10 to 12 trillion in market capitalization. But then if you say segment that and say, okay, what is the percentage that consists of private investment? Well, that's only, it's several trillion. It's much less than 10 trillion. And so in that context, that's still a very small percentage of net worth. And so that's actually one of the reasons why when people say, Bitcoin is going to displace gold, I point out that in the grand scheme of things, we have there's more than $500 trillion in assets worldwide, and so both of them are actually very small ponds in the ocean of assets. And so if it's more like I compare those to the size of the global bond market rather than get concerned about which one's going to take market share from the other.
Now, you did say that Bitcoin has been consolidating and it's the heat has fizzled off, so to speak. Where is the capital flowing? Is there evidence that it's flowed to a competing asset, equities, gold, anything that a Bitcoin investor could be interested in?
Well, we've seen a few different areas. One is we've seen somewhat of a resurgence of some of the mega cap stocks, right? So they also had a correction, along with gold more or less ever since rates started rising in summer of 2020. A lot of those big tech stocks have kind of gone sideways. Some of them have corrected, and in more recent, the past month, a lot of those have broken back out, and so capital's flowed back into those. We've also seen the classic alt season phenomenon. So generally, when Bitcoin has bull markets, there are periods of time where the thousands of other cryptocurrencies that are created start actually outperforming, and that's basically that investors are going out on the risk curve, right? So kind of like how if gold has a bull market, people buy gold and people buy large cap gold miners, and then they start speculating into exploration companies. And so basically, what you're seeing in the crypto space is that Ethereum's doing very well. That's the second largest cryptocurrency. And then if you
Yeah.
go down into DeFi protocols and things like that, a lot of those have been explosive. You also see NFTs, they've taken some of the heat away. We also, of course, had that big Dogecoin spike. And then, recently you've had a correction in multiple currency of them. Ethereum's been particularly strong over the past, couple weeks. And so you kind of see these rotations that are happening around the margins in that space. We've also seen gold kind of showing some signs of, not really, rising, but it's been somewhat consolidating after a correction. So that basically we seem to be having less capital flowing out of gold, and then we see some stabilization there.
It's interesting of these assets you named equities as probably, in your opinion, the most overvalued. Yet the Bitcoin and the other altcoins around Bitcoin have risen the most this year to what many people believe is already bubble territory. I wonder if you think it has more upside. If that's one of the reasons why you don't think it's more overvalued than stocks.
Well, I think there's still a good chance that Bitcoin has further upside this year. There's certainly, it's a less asymmetric trade idea than it was back in 2020 when it was, $10,000 a coin. So now that it's risen so much, there still are a lot of on-chain indicators that look attractive. So, for example, the percentage of coins that are held for more than a year, the amount of coins that are on exchanges, some of the ratios for what is happening between, you say, realized capitalization versus market capitalization. A lot of those still look constructive, but obviously it's less of a kind of a slam dunk trade than it was last year. Now, I would agree that I think a lot of the other protocols all are overvalued. And a classic case would be Dogecoin, because that's a protocol that was initially made as a joke. It
Mhm.
has, it has less security than Bitcoin, right? So it has less, much, smaller hash rate. It's easier to attack. It hasn't really been updated. It doesn't really have like an active development community like you see with, say, Bitcoin or Ethereum or some of these others. And so that's one where I think that after this kind of party ends, after we kind of maybe we get back to the the Fed tapering or something like that, that's where I think, especially as you go out to the risk curve of these other cryptos, I think there's a potential a lot of pain ahead for some of them, and even Bitcoin will probably have a correction. The big question is what level will it correct from?
No development support for Dogecoin. Much disappointment. Such sad. Much wow. Okay. Well, if you know the meme, you would understand what I'm talking about. Finally, I want to close on gold. Now, gold's valuation, it's tricky. There are a lot of factors pushing gold around. Last time we talked about the real interest rate being the primary factor. It probably still is. So let's just tie it back together. Everything we've talked about regarding the Fed monetary policy and the economy. Where do you see real interest rates headed? And how would that impact gold for the remaining quarters of this year?
Yeah, since our previous conversation, we still see gold closely tracking real interest rates. And that part of the reason why gold was able to find, maybe not the bottom, it could be, but at least a local bottom in the sense that, 10-year yields stopped going up rapidly. They started, they consolidated, they went back down a little bit at a time when inflation expectations were still strong. And so real yields, decreased again. They haven't gone back down to where they were in August 2020, but they've eased, and that has allowed gold to bounce. And so basically, as we look forward, like we mentioned, we have these base effects coming up, and so some of these headline CPI numbers, could be pretty surprising. And 10-year Treasury yields, it's a very large market. It's unable to move as quickly, even though as we saw in say months ago, it can actually move pretty quickly. But compared to what these base effects are going to be like in later this spring, it's quite possible that you get even further down negative yields.
Mhm.
And so that's kind of the big challenge with gold investors, is that they have to forecast both inflation and they have to forecast bond yields. And so overall, I think the risk to reward ratio is somewhat improving in gold's favor for investors that don't mind the volatility. In addition, if you look at where gold is, and if you look at, say, the free cash flow that's being generated by gold miners, a lot of them are doing great at current gold prices. And so, unlike, say, the 2011 spike in gold, they're controlling expenses. Energy prices are still pretty low. They're not plowing money into, say, bad capex or bad acquisition projects. And so a lot of that money is going right to their bottom line, and then they're strengthening their balance sheets. They're paying dividends. And so overall, the gold mining industry is in a pretty healthy space, even at current gold prices, let alone if gold were to kind of rise from here. So that's kind of the space that I'm watching. That overall, that's it's a pretty healthy market in my view at the current time, and there
Mhm.
are ways to hedge it. So, for example, if you think inflation's going to run hot and bond yields might go up, then you can also invest in say banks, for example, that benefit from that steeper yield curve
Mhm.
and benefit from that more pro-inflationary environment alongside gold or gold miners.
All right, so final question now. Putting all this together, how would you allocate your portfolio? Let's say well, not even a new investor, but let's say an investor who already has money in the markets. Should they be reallocating given your outlook on Bitcoin, stocks, and gold? Which of these assets would you put more money in? And if you were to go into stocks, which are the sectors that you prefer?
So overall, I would have a rather diversified portfolio, and kind of emphasizing areas that are less hot. And so, for example, if you look at global equities, there's still many cheap equities out there. Basically, we've had this big feedback loop of the United States running very large trade deficits, and then the foreign sector reinvesting from their perspective, their dollar surpluses into U.S. assets. And so that's part of the reason why we pumped up the asset prices so much. But that effect hasn't really been there for foreign countries. And so a lot of them have, pretty attractive value sector spaces. For example, Japan has really strengthened their corporate balance sheets. They've improved their corporate governance over the past decade. So many of them, are pretty attractive. We also see, select emerging markets. There's not a lot of, investor interest in them at the current time. Some of those are pretty attractive. I would also have a gold and a Bitcoin allocation in that
Hmm.
portfolio. And then in the United States, for example, we can look at some of the sectors that have lagged a little bit. And so, for example, the healthcare sector has some pretty strong free cash flows at the moment, very attractive valuations, but it's temporarily out of favor. Partially because concerns about regulation, but then also because there's so much euphoria about these more pro-cyclical investments. Whereas I think if we say look forward to quarter 3 when some of these base effects might be weaker, then investors could turn more towards some of those defensive areas like healthcare.
All right. I'm disappointed you didn't leave room there for Dogecoin, but that's fine. We'll save that for another time when it's a much bigger coin, if one day it becomes anything more than it is. Thank you very much, Lyn. Where can people learn more about your work?
So I'm at lynalden.com, and so I have free material and a low cost premium service. I'm also active on Twitter at Lyn Alden Contact, and thanks for having me.
Thank you for being here, as always. And thank you for watching Kitco News. I'm David Lyn.